Welcome into another Monday market update. I'm here with Scott Zelniker and Chris Bostick today. Last Friday, retail sales reports came in weaker than expected, yet the market's still sitting at all-time highs. Investors are essentially looking through softer economic data because earnings have remained really strong and inflation continues to moderate. Scott, what is the market telling us about the economy right now?
So the market's telling us it's a changing economy. Retail sales today don't tell the whole story. People aren't necessarily buying more pairs of jeans or notebooks for school, but they are spending money on their subscription services, their smartphones, right? Chris, I mean, I know you have young kids. Are they growing up playing games or are they playing video games,
Yeah,
right? It's
yeah,
it's kind
yeah.
of a
It's
new
a it's a different world now. It used to be you would buy the baseball bat. Now you buy the video game.
yeah. So I think retail sales today are a slightly different measure than they used to be. The other thing that I'm gleaming from it is the market is also worried about rates. We've talked about this on our previous shows. We've talked about it on TV appearances. And I think slower retail sales is giving the market some confidence that we're not going to have to raise rates here. I've been talking about actually cutting rates. So I think that's given the market some leverage here too. And let's not forget, we're getting into late summer and trading tends to be muted this time of year.
While we're talking about retail sales, Chris, this week we hear from Walmart, Target, Home Depot, and Lowe's. Why should investors care about these reports, even if they don't own the stocks?
Yeah, so this week is going to be a big week for the U.S. consumer, right? We're hearing from Home Depot, from Lowe's. We're going to hear from Target. We're going to hear from Walmart. That's really going to give us some insight into the health of the U.S. consumer, where the consumer is really standing. We're going to see from Home Depot and Lowe's, we'll get some insight into the housing market. We're also going to get some insight into some of those big ticket discretionary items, whether or not that's slowing, whether it's keeping pace. And then with Walmart, probably going to give us the most broad aspect of what the U.S. consumer is doing now. And I think it's really, answering the question of, is there slowing? And if there is slowing, do we think that that's more of consumers just being selective, or is there, a bigger problem? Is inflation actually coming up to bite people? Is there an issue with jobs numbers? Are people worried about spending more now?
So, Chris, it's funny you talk about that. When I was growing up in the business, I've been doing this since 1992. It was really a consumer driven economy. If
Mm.
you think about the money today and where it's coming from and where it's flowing, it's a lot of capex spending, isn't it?
Yeah.
So I think from a market and a global US economic um, perspective, I'm not sure the consumer has as big a role as they did in the past.
Yeah, I don't think so either. I think a lot of what we get from these reports is just kind of understanding, we hear about these inflation numbers all the time, but where do they actually show up? And I think that these are the numbers that can actually show us, okay, is if inflation is as bad as people are saying it is it showing up in the numbers, or are people still spending,
Yeah.
So,
And it seems like AI is shifting from hype to show me the earnings. Chris, a year ago, investors rewarded AI spending almost automatically. Are we moving into a phase where companies need to prove they can generate earnings from these investments?
yeah, so AI has been dominating the conversation here for a long time, for good reason, right? And there's two questions I think that people are trying to answer here. The first question is AI real? I think that's been answered, right? AI is real, right? The hype is real. The second question is whether or not AI and the spending can actually lead to profits, right? Where is that going to come from? There's obviously a massive amount of spending, the money that's going into infrastructure, right? At a certain point, it's going to turn from the hype around what AI can do and more about, okay, what can it actually produce? And Scott, I know you've been talking about, we're in the early innings of this. I think that investors shouldn't be so much worried about maybe this year or this quarter's earnings. But you kind of look at this as, we're kind of in the beginning of this and shouldn't be so worried if some of the earnings numbers don't look like they're as positive as what people like them to be right away.
Yeah, it's about efficiencies, isn't it? It's people think AI, I got to go buy some technology stocks. That's not necessarily true. It's the efficiencies across all businesses. Now, we can sit here and we can have a healthy debate, and rightfully so, about AI and how it impacts the individual in the context of jobs, and whether or not some of the more standard jobs may disappear. They might, but from a stock market and investing in corporate profits perspective, it should be very positive. And I think what you're going to see is you're going to see the job market change. It was interesting. At one of my kids' high school graduations, the principal was talking about the fact that many of the jobs that our kids are going to do in the future don't even exist today. So I think, as people look at it and they're looking for the profitability, they may just be looking in the wrong places. You may see pharmaceutical companies become more profitable. You'll see industrial companies become more profitable because of AI. And I don't know that it shows up exactly where people are looking.
Yeah, I agree.
So, Scott, we've been talking about the Fed for the past couple weeks. The Fed minutes are released on Wednesday. What are investors hoping to learn, and does the Fed still represent a bigger risk to this rally?
Yeah, so look, the Fed is a big risk to this rally. So there's going to be some people in the camp of they better raise rates to ward off inflation. There's going to be some people that are going to say wait and see. And then there's going to be some people like myself that say, hey, maybe the next move should be down. But we've talked about this a few times. Now, one of the things that's scaring me a little bit in the marketplace right now is the VIX, the volatility index. I always like to say when the fear gauge goes up, when the VIX goes over 30, I like to be a buyer of stocks. You look through history, it goes through 30 and it can spike from there, it can go 50, 80. But if you've consistently bought the VIX over 30 or bought stocks when the VIX is over 30, you've made money. Right now, the VIX is around 15. It's actually at the lowest level of the year. I think the market's getting a little complacent here. And no matter what the Fed does, what they say in the minutes, if they're divided, if they're unified, whatever it is, I think the market may get a little scared. So don't be surprised if we get a little bit more volatility here, because the downside volatility tends to come when nobody's looking. Every big bear market, every big decline has come off a market top, hasn't it? Now, we're still very bullish on stocks. I don't mean to, paint a bearish picture here, but I think in the short run, expecting some downside volatility, it's probably reasonable here.
Yeah, Scott, I would agree with that. I think, the Fed is certainly the biggest macro risk to the market in general now. And it's important that we, keep our heads on as investors, right? Not as traders. And we can kind of look underneath it a little bit and say, sure, is there, regardless of what they do, like you said, are they going to tighten? Are they going to keep it the same? At the end of the day, we're not at that 2% target, but at least it looks like inflation's moving in the right direction. And I think as investors, that's a very positive thing to look at.
As long as we don't have stagflation, we're going to be okay. Stagflation would be a problem. So how do you avoid that from here? You stimulate the economy.
Yep.
So as we look ahead, what's the one chart, company, or data point that you guys are watching most closely this week? Let's start with you, Chris.
Yeah, so I'm really looking at Walmart earnings. I think that's going to give us a good broad view of the U.S. consumer. Scott, like you said earlier, I think, maybe not necessarily the biggest driver of the market. However, I think that does give us a little bit more insight into, is the consumer feeling pressure from the job market? Are they feeling pressure from inflation? I'd like to see not see so much slowing from a spending standpoint in terms of the consumer.
Yeah, I don't know that it's one thing that I'm watching. I'm looking just more macro. Again, I think we're in the summer season. I think volume in the market matters. If you see moves that are a little more pronounced, I'd like to see if it's on heavy volume with conviction or if it's just light trading. When you get light trading, you tend to get outsized moves. Um, we're also in the time of year where markets tend to have a little trouble going into September, October. That's seasonally a little bit rough. Markets tend to bottom in September, but we're looking at midterm elections now. And, we've talked about the tailwinds in the markets, deregulation, favorable tax policy, and improved productivity from AI. What if the political landscape changes and the favorable tax treatment and the deregulation start to come into question? How does the market digest that news? So overall, we're wildly positive on the market. I mean, we've talked about this ad nauseum that the backdrop is really strong. Short term, it could get really choppy here, and that's okay. We're not active traders for our clients. We look for opportunities. And I always say real money is made for clients when the market's down, not at the top. You make incremental returns when you're making new highs. You make real returns when you've blown through the lows.
Great. Thank you guys so much for joining us today. The insights are always amazing. We'll see you guys next week.